If you're a business owner or a tax professional in India, you've got to get your head around the new Income Tax Act of 2025. Today, we're zeroing in on one key piece of it, Section 28. Trust me, it's a big deal and could really affect your bottom line.
All right, let's bring this down to earth. Think about your business. You pay rent, right? Taxes? Repairs? Of course you do. They're just the cost of doing business. But here's the million-dollar question. Are you positive you're claiming these deductions correctly under the new act? A lot of businesses actually aren't, and that can be a costly mistake. So let's figure out how to get it right.
So to really wrap our heads around this, here's our game plan for today. We'll kick things off with the big change, then get into the nitty-gritty of deductions, walk through a real-world example, and then wrap up with some absolutely essential compliance tips. Ready? Let's get started.
Okay, first up, tax law can feel, well, let's be honest, it can feel like a tangled mess sometimes, can it? The good news is the new Income Tax Act of 2025 is actually trying to fix that, and Section 28 is a perfect example of this move towards simplification. So what's the big idea behind this new act? It's really all about three things: simplify, clarify, and consolidate. The whole point is to cut down on that confusing jargon and those scattered rules. The goal? To make the tax law more predictable, more transparent, and hopefully make life a little easier for everyone.
And here, this is the perfect illustration of that simplification I was just talking about. Under the old 1961 Act, you had two different sections to deal with. Section 30 was for buildings, and Section 31 was for things like machinery and furniture. Now, under the 2025 Act, they've merged them into one single, unified section, Section 28. Everything related to these business assets is now in one logical place. Much cleaner, right? Okay, so we've seen why things have changed. Now let's get into the what. What can you actually claim as a deduction? We'll start with the most common costs, your premises and insurance. So Section 28 lays it out pretty clearly. If you're renting your business space, that rent you pay is a straightforward deduction. And it doesn't matter if you're a tenant or an owner, any land revenue, local rates, or municipal taxes you pay are also on the list of deductible expenses. These are the fundamental costs of having a place to operate. Now, this next point is absolutely critical. It's kind of the golden rule for every single deduction we're talking about today. The asset, whether it's your office, your computer, whatever, it must be used for the purposes of the business or profession. So what if you use something for both business and personal reasons, like a home office? Well, you have to apportion that expense. You can only claim the part that's related to your business. The Act also understands that you need to protect your business assets. So any insurance premiums you pay to cover your premises, machinery, or furniture against risks like damage or destruction, yep, those are fully deductible too. It's all about making sure the backbone of your business is safe. All right, we've ticked off the easy stuff. Rent, taxes, insurance, pretty straightforward. But now let's get into a slightly more nuanced area, repairs. This is where people often get tripped up, so let's break it down really carefully. This phrase right here, pulled directly from Section 28, is key. You've got to understand the difference between current repairs and capital expenditure. Think of it like this. A current repair just maintains an asset, brings it back to its original condition. A capital expenditure, on the other hand, improves it or creates something new. Only the first one, the current repair, is deductible as a regular expense. This table really helps clarify things. See, the rules are different depending on who you are. If you're the owner of the premises, you can claim for current repairs. Easy enough. But, and this is a big but, if you're a tenant, you can only claim repair costs if your rental agreement specifically says that you're the one responsible for them. For other assets, like machinery or furniture, it's simpler. Whoever is using the asset for business can claim the repair costs. Okay, enough with the theory and the rules. Theory is great, but how does all this actually work in practice? Let's take everything we've learned and apply it to a real-world scenario. So let's meet Creative Designs LLP. They're a small graphic design firm, and we're going to take a peek at their annual expenses to see exactly how Section 28 would apply when they file their taxes. Okay, so here's a quick look at what Creative Designs spent last year. They've got office rent, municipal taxes, they repainted the walls, they paid for insurance on their computers, and they also built a brand new cabin to give themselves some more space. So, looking at this list, what do you think they can actually deduct under Section 28? And here's the breakdown. The rent, taxes, and insurance, no-brainers. They're all deductible. The repainting, that's a yes too, because it's a current repair. It's just maintenance. But the new cabin, that's a no. Why? Because it's a capital expenditure. It's a brand new asset that adds long-term value, so it can't be claimed as a day-to-day expense under this section.
So Creative Designs navigated that perfectly. But how do you make sure you get it right every time? This is where good compliance comes in. Let's talk about how to claim correctly and, just as importantly, what common mistakes to avoid.
Honestly, think of this as your essential checklist. First, keep every single invoice. You need a solid paper trail. Second, make sure your rental agreements are crystal clear, especially about who pays for repairs. Third, be super diligent in your books about classifying expenses as either revenue or capital. And finally, always be ready to prove that the assets you're claiming expenses for are actually used for your business.
And here are the traps you need to watch out for. A big one is trying to claim a major upgrade as a simple repair. Another classic mistake is a tenant trying to deduct repair costs when their lease doesn't say they have to pay for them. Also, forgetting to split expenses for assets that are used for both personal and business life is a common error. And of course, the simplest mistake of all, just not having the invoices to back up your claims. Avoiding these will save you a world of pain later on.
All right, we have covered a lot today. So before we wrap up, let's just quickly recap the most important things you need to remember about Section 28. Look, if you only take away a few things, make it these 5. 1. The new law simplifies things by consolidating old sections. 2. It covers all the basics: rent, taxes, repairs, and insurance. 3. The difference between a repair and a capital improvement is absolutely crucial. 4. The rules for who can claim are different for tenants versus owners. And 5. Documentation. It's everything.
So I'll leave you with this one final thought to take back to your own business or your clients. Take a hard look at your chart of accounts. Is it actually set up to handle these rules? Can you easily track and separate capital expenses from revenue repairs? Getting your accounting structure aligned with Section 28 now is going to make your life so much easier in the long run.
And that's a wrap on Section 28. Thank you so much for joining us. We really hope this deep dive was helpful. If it sparked any questions, please drop them in the comments below. And hey, if you found this valuable, please give us a like, subscribe for more content, and share it with anyone else who might need to see it.
And just before you go, please take a moment to read the important disclaimer on your screen.